Before buying a company stock, I follow a three-step evaluation process. First, I look at the fundamentals or the big picture, such as its business model, leadership position within the industry, and any secular trend it's benefiting from. Second, I examine the company's operational performance and financial strength. Finally, I determine the intrinsic value of the company using a simplified discounted earnings model I developed. This process ensures I make investment decisions based on data rather than emotions or speculation. Investing in individual stocks without going through such a process is like driving a car blindfolded. If you're not willing to take the time to analyze the businesses you are putting your hard-earned money into, individual stock investing may not be for you. In that case, buying market index ETFs is the better option. However, if you're ready to do some good detective work, stock investing can be very rewarding. In this video, I will show you how I used my three-step process to make Meta one of the top holdings in my portfolio and how I identify only the best companies to own for the long term. This channel is all about investing and personal finance to help you achieve financial independence. I first bought Meta stock after its Q1's earnings report in early May and continued building my position to reach over 7% of my portfolio. As of today, Meta is my second largest holding right behind Nvidia. Why did I buy Meta? First, the fundamentals. I use a common sense set of stock selection criteria to identify great companies. For a full explanation of these criteria, check out the video I linked here. Meta is included in both the S&P 500 and the Nasdaq 100 indexes. It has built a powerful ecosystem by integrating all of its apps: Facebook, Instagram, WhatsApp, and Messenger, allowing users to switch between apps within a single login and cross-app messaging. More importantly, for advertisers, a single ad campaign can be managed to target the same user across all platforms using behavior-driven insights powered by a single AI engine. Meta is a digital advertising powerhouse, generating about 98% of its revenue by selling ads across its apps. The more active users it attracts, the more it can earn from ads. It's clearly a consumer-facing business. Family, friends, influencers, and followers spend an average of 2 hours per day on Meta apps. With the 3.48 billion daily active users, Meta is the largest social media company globally, well ahead of YouTube's 2.5 billion monthly users. It holds near monopoly status, which has led to government investigations. In 2020, the Federal Trade Commission filed an antitrust lawsuit over Meta's acquisition of Instagram and WhatsApp. Such legal cases usually take years to resolve but are important for investors to keep an eye on. Meta is highly profitable, with $62 billion in net income and an EPS of $24 for 2024. I see two megatrends Meta is deeply embedded in. One is digital media, which has become the foundation of modern culture. From streaming entertainment and influencer-driven retail to real-time political movements and online education, digital media on mobile devices is now part of everyday life. Meta is not just riding this trend, it's leading the way and shaping the future of digital media. The second trend is generative AI. Meta is investing aggressively in AI infrastructure, talent, and product development. As Mark Zuckerberg stated in Meta's Q2's earnings call, operational AI solutions have already improved advertisement conversion rates and user engagement. Meta AI, its personalized AI app, has reached 1 billion monthly active users. Together with AI-driven devices like Meta Glasses, this could become the company's new growth engine. Finally, I see Zuckerberg as a visionary CEO, not just someone who delivers strong results, but someone who creates megatrends. I like Tim Cook, who is an excellent business operator, but more cautious in strategy. Zuckerberg's forward-thinking leadership gives Meta a competitive edge, especially in AI, where Apple is now falling behind. Looking at the big picture, Meta checks all the boxes to be a market outperformer. Now let's review a few key operational and financial metrics I use to evaluate its performance. Meta's gross margin of 82% and operating margin of 43% underscore its pricing power and operational excellence. The other two metrics, net debt to free cash flow and debt to equity ratios, come from the balance sheet. Net debt to free cash flow shows how long it takes a company to pay off its remaining debt using its annual free cash flow, after accounting for any cash it already has. In Meta's case, the company has more than enough cash and cash equivalents to pay off all its debt. That gives Meta a negative net debt, which also makes the ratio negative a strong financial signal. For comparison, Apple's ratio is 0.68, meaning it could pay off its remaining debt in just 8 months using its free cash flow, also a sign of solid financial health. Meta's debt to equity ratio is 15%, which shows it relies more on shareholder equity than debt to fund its operations. Companies can raise capital by either taking on loans or issuing stock. In comparison, Apple's ratio is 154%, meaning it uses much more debt, making it more financially leveraged. Using too much debt can make a business riskier, especially during a recession. However, high debt isn't always a bad thing if the company can generate strong return on invested capital, a metric known as ROIC. While return on invested capital is more complex to calculate, I simplify my evaluation process by instead using return on equity, or ROE, as an indicator of how effectively a company creates value for its shareholders. But ROE alone doesn't tell the whole story. To get a clear view of how well a company creates value, I compare ROE to its cost of equity, a measure I call the ROE to equity cost ratio. Let me explain what that means. Just like borrowing money comes with interest, equity has a cost too. If a company runs business entirely on debt and earns 10% return, but also pays 10% interest, it's not creating any value, since all the income goes to the lender. The same idea applies to equity. The cost of equity is the return investors expect when they buy a company stock. It's based on 3 things: the stock's volatility or beta, the risk-free rate, usually from treasury bonds, and the overall market return. If a company stock has a beta of 1, its equity cost is the same as the historical return of the S&P 500. I use 9.5% as my baseline. If the beta is higher than 1, investors expect higher returns to justify for the actual risk. For Meta, the ROE is 41%, meaning the company generates 41 cents in profit for every dollar of shareholder equity. With a beta of 1.27, the cost of equity comes out to 10.9%. That gives us a ROE to equity cost ratio of 3.73. In other words, Meta generates more than 3 times what investors expect, showing it's running a highly effective and profitable business. Compared to Tesla, its ratio is below 1, meaning it's actually destroying shareholder value rather than creating it. Next, I look at the free cash flow to net income ratio. It shows how much of a company's reported earnings actually turns into real usable cash. A ratio above 0.8 is considered strong. Meta's ratio is 0.67, mainly because of its heavy capital investment in AI, which reduces free cash flow in the short term. The final metric is the projected 5-year EPS growth rate. I assign weights to each metric to calculate an overall performance rating, and Meta scores 84 points. Compared to other Mag 7 companies, it has earned a well-deserved spot in my top 3 holdings. Companies like Apple, Amazon, and Costco typically rank lower than high-growth peers. I generally avoid investing in any company that scores below 50. My rating system is focused on value creation or growth. It may not be suitable for every investor, especially those with different risk tolerances or objectives. Now that we have identified Meta as a high-quality company, the next step is knowing when to buy, hold, or sell a stock based on its intrinsic value. I use a discounted EPS model to estimate that value. The details of this model are explained here in this video. Using a projected 14% EPS growth rate, I estimate Meta's intrinsic value at $915. With the stock recently trading as high as $780 after a blowout Q2 earnings report, it still looks undervalued, with a safety margin of 18%. Since valuation depends heavily on projected growth, which can be uncertain, I use a safety margin range to guide my actions. If the margin is above 15%, I consider adding to my position. If it drops below 20%, I consider trimming, unless the stock is already underweight in my portfolio. The performance rating and discounted EPS models are great tools for evaluating a company. When combined with understanding the big picture or the first step, not only can they help safeguard your investment, but they can also give you a strong chance of achieving market outperforming returns. If you'd like to learn more about my evaluation models, feel free to reach out via the email in the description. See you soon.